Crypto just did the opposite of what everyone expected. The Fed cut interest rates again, third time in a row, and instead of sending Bitcoin and Ethereum to new highs, the market dumped. Bitcoin spiked to around $94,000, and within hours it slid back towards 90. Ethereum ripped up and then gave the whole move back. So what on earth just happened? And what does this tell us about where the market is really heading next? If you're new here, hi, I'm Paula. On this channel, we break down what's really going on behind the candles, macro, on-chain data, and the psychology of retail versus whales. So you can stop trading on the headlines and start understanding the bigger picture. Let's get into it. What did the Fed actually do? First, a quick recap of the Fed's meeting so we're all on the same page. The FOMC just delivered another 25 base points rate cut. That brings the policy rate down into the 3.5 to 3.75% range. And it's the third straight quarter point cut to close out in 2025. On paper, that sounds exactly what risk assets, including crypto, wanted. Lower interest rates mean cheaper borrowing for households and businesses, more willingness to take risk, a friendlier backdrop for things like tech stocks, growth companies, and yes, Bitcoin and altcoins. The Fed's statement still describes the US economy as growing at a moderate pace, especially around a weakening job market, and it now leans towards easing rather than hiking. So you'd think rates down, liquidity up, crypto moon, right? Not quite. There's another part to the story that hardly anyone on mainstream TV is talking about, and Santiment picked up on it. This isn't just about interest rate, it's about liquidity. Back in October, the Fed quietly decided to slow down the pace of quantitative tightening. Basically, they reduced how quickly they're shrinking their balance sheet. From the 1st of December, they eased the rate of balance sheet runoff. They went further. They said bank reserves had fallen too much, and they announced they'll start buying short-term treasury bills again to keep reserves ample. So we've gone from actively shrinking the balance sheet to gently topping up the system with T-bill purchases. It's not full-blown money printing, but it is a shift from draining liquidity to quietly adding some back in. For crypto over the medium term, that's usually a tailwind. More reserves sloshing around the system tends to find its way into risk assets eventually. So again, why did prices tank? Let's talk numbers. Right after the announcement, Bitcoin did exactly what you'd expect. We got a breakout move. Prices spiked to around 94,000. Ethereum pushed up to about 3,400. XRP tagged the $2.10 region. Solana ripped to about $142. And then almost immediately, the rally faded. Bitcoin dropped more than 5% from the spike high. Ethereum fell more than 8.5% at one point. The wider market rolled over with it. So the headline is, Fed cuts rates, everything dumps. But that doesn't mean rate cuts are bearish. It means something very different. This move was already priced in, and the event became exit liquidity. This is where Santiment's data gets really interesting. They call this whole episode a trap, not because the Fed cut was unexpected, but because of how positioning looked going into the meeting. In the hours before Powell even opened his mouth, prediction platform Polymarket was showing an overwhelming amount of optimism. Traders were basically betting the house on a bullish outcome. On-chain, there was abnormal activity. A large whale sold roughly $100 million worth of Bitcoin within an hour, right around the event window. And that kind of sell doesn't happen by accident. It happens when someone knows everyone else is leaning the same way, and they use the liquidity spike to cash out. So what did we see? Retail traders treated the Fed cut as a green light to pile in. Whales treated it as exit liquidity to offload into. Santiment's social data shows that the positive versus negative comment ratio for Bitcoin had already peaked well before Powell spoke. The emotional high came in anticipation. When the actual rally hit, the crowd's reaction was relatively muted. Sentiment was already exhausted. With Ethereum, it was even more textbook. Huge wave of FOMO comments as ETH broke out. And then those late buyers got burned when price dumped straight back around 3170. Classic. Buy the rumour, sell the news. So let's put this together. Why didn't lower rates equal higher prices, at least in the short term? There are a few key reasons. Number one, the cut was fully expected. Markets have been pricing in this third consecutive 25 base point cut for weeks. Bitcoin had already run into the mid-90s on rate cut expectations. When the thing everyone expected actually happened, there's no new fuel left. That's when smart money starts taking profit. Number two, the guidance was still cautious. Yes, the Fed cut, but they also signalled they're not about to start a crazy easing cycle. Inflation is still above target, and the dot plot points to only limited further cuts. That's not turn back the money printer on. It's will support the economy, but we're watching the data. So for big institutional players, this isn't enough to justify chasing risk at any price. Number three, cross-asset risk sentiment flipped. We had disappointing earnings from major AI-linked companies, which spooked equity markets and reminded everyone that risk assets can go down as well as up. When stocks wobble, high beta stuff like crypto tends to get hit even harder. So you have this weird mix of macro optimism about low rates, but fear about earnings, growth, and how sustainable the AI and tech rally really is. That's not a clean all-in environment. Number four, positioning was skewed. A lot of leverage had built up ahead of the event. Longs chasing the breakout, options positions leaning bullish. When price failed to hold the highs, you get liquidations, stop runs, and forced selling layered on top of that whale exit we talked about. That accelerates the move back down. So it's not that the rate cuts are bearish. It's that we're in the cycle in terms of sentiment, leverage, and expectations that made the reaction bearish. Here's the twist. Santiment's report is actually not screaming doom and gloom. They point out that year to date, Bitcoin is only down about 3 to 4%. The S&P 500 is up around 17 to 18%. Gold is up over 60%. That's a huge performance gap. If you believe Bitcoin is still a macro asset that's benefiting from easing and liquidity, you could argue there's a strong catch-up case over the next year or two as policy slowly loosens and the economy stabilizes. On-chain, wallets holding between 10 and 10,000 Bitcoin have added over 42,000 Bitcoin since the end of November. That is not retail. That's larger players quietly building positions while everyone on social media screams about the post-Fed dump. What Santiment says they're still waiting for is a proper retail flush, a phase where smaller traders finally capitulate, stop buying every spike, and maybe even start rage selling into weakness. Historically, that kind of behaviour shift often marks the start of much stronger, more sustainable uptrends. So short term, yes, this was a painful reminder not to ape into the first candle after a Fed meeting. But structurally, the combination of 3 rate cuts now locked in, a softer stance on liquidity and bank reserves, whales accumulating while retail gets chopped up, actually builds a case for crypto to have more breathing room in 2026. Here's what I'll personally be watching over the next few weeks. First, liquidity data. How aggressive the Fed is with those T-bill purchases and whether bank reserves keep ticking higher. If they do, it adds a support under risk assets, even if price doesn't react instantly. Second, on-chain behaviour, especially those 10 to 10,000 Bitcoin wallets. Do they keep accumulating on dips, or do they start distributing again if we push back towards the highs? Third, sentiment and social data. Are we seeing the crowd still FOMO every bounce? Or does apathy start to creep in? A quieter, less euphoric market is often a healthier one. And finally, the broader macro narrative. If inflation glides down and the labour market weakens just enough for the Fed to keep cutting without panicking, that's the sweet spot for a proper risk asset cycle. Remember, none of this is financial advice. I'm just sharing how I'm reading the data and how I'm thinking about this environment as a retail trader who's been through a few of these cycles now. So to sum it up in one sentence, the Fed did exactly what everyone wanted. But because everyone already positioned for it, the cut became a sell the news event, and crypto paid the price in the short term, while the medium-term backdrop might actually be improving. So let me know in the comments. Did you buy into the Fed pump and get caught in the dump? Or were you one of the people taking profit into that 94,000 spike? And what do you think? Are these cuts the start of the next big leg up? Or is there more pain before the real move? If you found this breakdown helpful, make sure to hit like, subscribe and turn on notifications so you don't miss the next update. And if you want to go deeper, join the Crypto Wolfpack. That's our community where normal people can share charts, macro views, and trade ideas together. And if you want to know the exact strategies we use to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. Thank you so much for watching, and I'll see you on the next one.